All right, in this lesson, we're going to walk you through interest on a notes receivable. How do we calculate that? And we'll end with an example that kind of goes through the nuances of what it would take to actually calculate interest on a notes receivable. So let's get started here. Some understanding of the interest receivable on the notes receivable. Interest on notes receivable are often paid twice a year, semi-annually. So you got to be careful when you're looking at these problems, because some of these problems are going to be calculate the month's interest, so the 1 month of interest. Other times it might tell you to calculate for a semi-annual payment, which is usually what notes do, or a period in between the 6 months you might have to calculate, but no payment being made. So it's super important for you to understand the context of the problem, because the problem is going to tell you what interest you're trying to calculate. Often though, interest on notes receivable are paid semi-annually, twice a year. Okay. However, the timing of the interest being paid versus the timing of when the period or year end occurs may be different. So the time that the end of the year occurs might not be that last payment of the year. It might be later on. And so because of that, we may have to accrue. We're going to have to book an interest expense for that period, even though cash doesn't even go out. Now, companies need to accrue that interest when the timing of the interest payment does not follow the accrual of the interest. So when we have that, we're going to need to figure out the accrual, the interest expense. So to calculate interest, if you haven't taken a finance class yet, it's going to look something like this. We're going to take the principal, so the principal amount that is due, we're going to multiply it by the interest rate, or R, and we're going to multiply it by time. Now, for all intents purposes, the interest rate is usually given to you in a per year basis, which also means that your time needs to be in a per year basis. So this right here, if it's per year and we're only dealing with half a year, this will need to be 1/2 or 6/12, because it's half a year. If this interest rate is per year and we're only calculating 2 months, then our time needs to be 2 divided by 12, because we only had interest that we're calculating for 2 of the full year. So it's super important that your interest rate time period matches your T time period. Now, if you're calculating for a year of interest, then you just need to put 1 in time, because we have 1 year and our interest rate is given to us in years. So be careful with that. I'm going to show you what that looks like in an example here soon enough. So when we do calculate that, we get our interest. All right. So let's take a look at an example here, and I'm going to walk you through how I would look at it from this calculation. So on September 1st, 20X1, company A sells $35,000 to a new customer who agrees to sign a 5-year note in which interest is paid March 1st and September 1st of each year. And the principal of the note is due in 5 years along with any accrued interest. So kind of walking you through. So we are selling equipment to this customer, $35,000 worth of equipment. The $35,000 is due in 5 years. So they're not going to make micro payments along the way. They're just going to pay us a lump sum at the end of 5 years of $35,000. Now, in between now and the $35,000 being repaid back to us, they're going to pay us interest. So it's an interest-only loan, and at the very end, they pay the principal and the interest at the same time, or principal and the accrued interest at the same time. So every 6 months, we're going to get a payment of the interest only. Okay. The interest rate is 4% per year on the note. Calculate the interest on December 31st. That will need to be accrued to close the 20X1 book. So what we have here is we have the first payment happening on March 1st of 20X2. However, our books close on December 31st, 20X1. So some time has gone by between when we took out the note, when the customer took out the note, September 1st and December 31st. So we need to accrue the interest for that period, because we need to close the books. We want the interest expense, interest revenue to be in the correct period in which we earned it. So we got to do this calculation to book that interest revenue. So we've got our equation here, principal times rate times time equals our interest. So let's look at these three boxes individually. So principal would be how much is owed back to us. So in this case, we lent out basically $35,000 to our customer. So our principal would be $35,000. Now we need to find our interest rate. The interest rate, according to this problem, is 4% per year on the note. So we're going to put 0.4. We're going to turn it into decimal. That's going to give us our interest rate. Now we get to our time. So the interest rate of 4% is on a yearly basis, but we're only trying to calculate the time period from when the last interest payment would have been made or when they took out the loan, in this case, September 1st, all the way to the end of our fiscal year in which we have to book a revenue. So in this case, September, October, November, December. 4 months has gone by. We need to accrue it. Now, they're not going to pay us at December 31st because when do they pay us? They pay us on March 1st. So 2 more months, and then they'll pay us 6 months worth of interest. So our time here has to be how much time has gone by? 4 months over 1 year. So 4 twelfths. Once we do that, we can get our interest. So I've converted that 4 months into a year. How many, what would that conversion be? Well, that conversion would be 4 divided by 12. 4 divided by 12 might be, I don't know, like 30 something percent. So if you do 4 divided by 12, you get like 30 something percent, and that would be 30 something percent of the year, I think. 33? I think that's what it is, 33. All right, so 35,000 times 4% times 4 divided by 12 gives us an interest for that period of $466.67. So what we're saying here is that for those 4 months, we have earned $466.67 of interest revenue. Now, it didn't say anything about doing the journal entries, but let me do the journal entry just in case so that you know what it looks like. So in this case, we earn this revenue. So we're going to credit interest revenue for, can't write and talk at the same time, $466.67, and we're going to debit interest receivable. So interest receivable for $466.67. So what we're saying here is that we've earned this $466.67, but we haven't been paid for it, so we're going to put an interest receivable so that in March, when we do receive 6 months, a portion of it has already been booked in last year, 20X1, and the rest will be booked in 20X2. So that would be our journal entry. On December 31st, the adjusting entry for the revenue that we have earned, but we have not received in cash. So that's a look at interest on notes receivable. Again, some of the buggers about this would be understanding time, making sure that you're converting it into years rather than just putting 4, because if you put 4, it's going to give you a totally different answer than if you do 4 twelfths. It's also understanding when your payments are. So this is a little bit complex because we made sure that the payment happened after, on March 1st, but we need to accrue as of December 31st. So understanding that. So it's super important you understand the entire problem and the concepts and what's happening. The best thing that you can do when you're trying to get to this problem is sometimes draw out a timeline and kind of put visually what those timelines look like so you can see, oh, it's 4 months that we're trying to calculate interest revenue rather than 1 full year or 4 years in our calculation. So that hopefully that helps you understand interest on notes receivable. Hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.